Hello everyone, thanks for checking out my video. The US stock market has been on a nearly unstoppable bull run since October last year as the three major indexes clinched their fifth straight winning month. S&P 500 closed out last Thursday at yet another all-time high, something that it has done more than 20 times this year. In addition to that, it also posted its strongest first quarter since 2019. So, as the first quarter of the year comes to an end, some investors may start to wonder if this bull run could continue for the next quarter, starting from the month of April. Also, we are going to enter another new earnings season this month. Is there anything particular we need to be wary of? Let's cover these topics in this video, and as usual, do watch on to find out more. Last Thursday, S&P 500 ended the first quarter with a return of more than 10%, which marked a second straight quarter with double-digit returns. That's super impressive because the last time the index finished two consecutive quarters with gains of more than 10%, it was back in 2012. That's more than a decade ago. Here are more impressive statistics. The S&P 500 has set a new record closing high more than 20 times in just one quarter. If this carries on, that's more than 80 times of record closing price by the end of the year. On top of this, the index also registered its best first quarter performance since 5 years ago in 2019, before COVID pandemic hit the world. That year, S&P 500 gained around 13% in the first quarter. Individual stocks-wise, Nvidia is the top performer in the Nasdaq 100 as it jumped 82% in the first quarter of this year. But within S&P 500, the best performing stock for the quarter isn't Nvidia. It is Super Microcomputer, as the share price skyrocketed a whopping 255% year to date. Okay, enough of the impressive statistics. On another note, the latest University of Michigan survey showed consumers expect inflation to fall to 2.9% in the next year. This is a drop from last month's expectation of 3%. This means that consumers are showing confidence that inflation will continue to soften. Alright, sentiment and feelings aside, there were also positive news from more concrete data. First of all, the US saw a stronger than expected GDP reading for fourth quarter. The latest report showed the economy grew at a rate of 3.4%, higher than the estimate of 3.2%. And then on the employment front, initial jobless claims for the previous week came in at 210,000, which is slightly lower than the estimate of 212,000. In terms of market outlook, it's going to be an interesting week ahead. Why so? Well, the Federal Reserve's preferred inflation measure, aka the PCE index, was released on Friday when the stock market was closed. The core PCE price index, excluding the food and energy, rose 2.8% year over year and 0.3% month over month. Both are in line with analysts' expectations. The new figures have showed less of a cooling inflation when compared to last year, but on the same day, Powell shared that this new inflation report is along the lines of what they want to see. So here's what he said last Friday. It's not as low as most of the good readings we got in the second half of last year, but it's definitely more along the lines of what we want to see. At the same time, he did also acknowledge that the Fed needs to see more good inflation readings like those in the second half of 2023. Okay, I don't know about you, but I thought both PCE index and Powell's words seemed quite positive. But that being said, we really don't know how the market will interpret them. As the market was closed last Friday due to public holiday, so the effects of this reading and Powell's words will only be seen this week. And I really think one should be prepared for both possible directions, instead of being too fixated that the market will take this news positively or negatively. Let's now move on to the technical analysis portion. SPY was pretty flat last week in terms of its price action. Not just that, both the RSI and MACD didn't move much as well. These sideways movements are probably due to a holiday shortened week that has little to no catalyst to move the market drastically, something that I mentioned in my last video. But that said, there were two positive takeaways. First of all, SPY has stayed above the support level of 521. Secondly, it created another all-time high. If the latest PCE data is interpreted positively by the market, then I think SPY could create more record highs this week, and we could maybe grind towards 536 before the new earnings season. Okay, on the other hand, if the market somehow doesn't like the new PCE data and if SPY falls this week, watch for 510 as the first support level. If this level breaks, okay, don't need to be too worried yet. In fact, I would be happy because the next target for the bears will likely be 500 to 501 level. That's where the next Fibonacci level and the 50 moving average are forming a double support area. Just to highlight, from the current price level of 523 to 500, that's a 4.4% drop, and this kind of pullback is quite healthy in my opinion. Okay, at the 500 psychological level, don't be surprised if it moves further down to fill the gap at 495 to 501 and kisses the green uptrend channel line. And from 523 to 495, that's about 5.3% decline. And if this happens, I will be excited and I will be considering picking up some shares here. But will this 4 to 5% decline happen in the upcoming weeks or even months? Honestly, I don't know. I wish I have a crystal ball. The point of this analysis is to let you know that when certain key support levels break, there is a probability for the price to fall further to the next key level. Okay, let's now check out Apple's chart. If you have followed my last two videos, you would have known to watch for two key levels for upside, and they are 175 and the purple downtrend line. So last week, Apple once again experienced some difficulties in breaking above both levels, as you can see from the chart. It attempted to go above the purple downtrend line towards the end of the week, but failed in doing so. With the latest PCE index and with Apple approaching the edge of this triangle formed by the 168 support line and the downtrend line, I think we will likely have an answer for the next direction. In terms of the bullish thesis, as previously shared, we want to see Apple breaking above the purple trend line and 175. When that happens, I do see a decent probability for Apple to at least hit towards 180. Above 180, do be a little careful if you are holding on to call options because we have the 50 and 200 moving averages acting as resistance levels, and these levels are 181 and 183 respectively. Okay, in terms of the bearish thesis, if the death cross bearish trend continues, we could see Apple finally breaking below 168 level. And I think it's important to highlight that this level is quite a critical support level to watch, as Apple has bounced off this level on 3 other occasions. Among the 3 occasions, there was a time when Apple fell to 165. So if you wish, give and take a little bit, use 165 as a key support level to watch. And as mentioned previously, anything below 165 to 168 area, I think Apple is very bearish, and we could finally see 150s range again. Interestingly, the last time Apple was at 150s range, it was April 2023. That was almost exactly 1 year ago. And so, if we get there, it means Apple has gone nowhere for the last 1 year. Moving over to Tesla's chart, I like how Tesla is moving within this bear flag that I have drawn previously. Just a quick recap, we have 2 bear flags on the daily chart, and that's obviously a bearish sign. As you can see, Tesla tried to break out of the bear flag last week with a gap up on Tuesday, but fell back down again. In short, we didn't have a clear indication of Tesla's next direction last week. But I would think the next trend will be decided this week as the company reports its Q1 delivery numbers. The Wall Street is quite bearish about the numbers, but does it mean Tesla will definitely plunge lower? Honestly, it's tough to predict. Some may argue that the market has already priced in the poor numbers as Tesla has fallen from 205 to 175 over the last 1 month. That was a close to 15% drop. On the other hand, others may argue that the numbers are going to be very ugly and more carnage is coming up for the stock, and Tesla could fall to 150s or even lower. Well, both arguments can be valid, therefore we should always be prepared to analyze both directions. First of all, remember I have asked viewers to draw the bear flag on your charts if you can, so watch this bear flag carefully again. I think we are likely to have a big movement this week. So if Tesla breaks below the bear flag, then I think we can say hello to 150's range. If you realize I almost totally skipped 160's range. But does it mean that Tesla will gap down from 170 all the way to 150 immediately? Well, not really. It just means I am of the view that Tesla will likely eventually fall to 150s if Tesla breaks below the bear flag. In fact, by saying 150's range, I am just being conservative. Because can you see the gap over there? The range is from 146 to 152. Also, the bottom of this downtrend channel line is around low 140s. So I wouldn't be surprised if Tesla slides towards 140s actually. Anyway, long story short, if Tesla breaks below the bear flag, I would stay by the sidelines to watch the price movement. I may probably wait till the dust has settled a little before stepping in for either a trade or to pick up more shares. On the other hand, if Tesla can break above the bear flag, that's a slight positive sign. But before bulls get too happy, you will need further confirmation of a reversal in trend. Basically, watch for a few key areas. The first one is the gap area between 184 to 186, and then it's the 50 moving average at around 187, as well as the critical 61.8 Fibonacci level at 188. Okay, it may seem like a lot of levels to watch, but if you lump them all together, it's just 184 to 188, and in Tesla's context, a 5-pointer range is nothing. So if Tesla can climb above 188 and stays above it, then I think we have a decent chance to visit 200 again. Okay, on a side note, please give me 30 seconds, no more than that. If you have benefited from my free weekly content, do consider supporting the channel by either buying me a super thanks or just simply tapping on the like and subscribe buttons, as well as share my videos with your friends. These actions will greatly help to grow the channel, thank you. Alright, moving over to Google's chart. Well, don't you love technical analysis? Look at how Google hugged that green dotted channel line so nicely last week. Just to share, I did not adjust the line. You can check out my previous video. Anyway, there are two ways to look at this movement. One way is that Google has been trending upwards with higher lows. That's leaning slightly bullish. But from another angle, one could also say that the bulls do not have the power to push Google back into this uptrend channel, and that's leaning a little bearish. Okay, as for me, my take is until Google moves away from this trend line, there is no clear winner between the bulls and the bears yet. For bulls to win this tug of war, Google has to get back into the uptrend channel. Not just that, it has to break above the all-time high of 153, then I would be convinced that Google is very bullish, and I think we may then head towards 160. But on the other hand, if Google gets rejected by the trend line, I would expect a high probability of Google falling to the gap area, which ranges from 143 to 146. At this area, there are multiple decent support levels, namely the 61.8 Fibonacci level at 145, the 50 moving average at 143, and of course the bottom of the gap is also a support level, which is also at 143. I believe the bulls will put up a good fight at this area. Okay, but somehow if something happens or Google's share price gets affected by some negative news again, we can say hello to 130's range again. That was the range that I picked up some Google shares. I am not asking you to do that, but it's something I would consider doing it again. At this 130's range, I may also sell cash secured put. Okay, not financial advice, but a strike price that I would consider is roughly the 200 moving average level at around 134, as this moving average has proven to be a very strong support level since March 2023. Okay, let's now talk about my options trade. But before I move on, just wanted to say, I have been sharing all my options trades for quite some time already. Initially, I only shared some of the more significant ones, but I don't know since when, every single trade of mine was shared for free in my videos. There are no Discord, no Telegram groups, no paid services, just pure free stuff. The reason for doing this is I hope viewers can learn from my trades about what have gone well and what have gone wrong. Therefore, if it's not too difficult, do help me hit the like and subscribe buttons and comment something below. They say this will help with the YouTube algorithm. Okay, anyway, last Tuesday, 26 March, Elon Musk announced that Tesla would offer a 1-month free trial of their full self-driving system to its car owners. He even asked Tesla employees to take customers on a short test ride before handing over the car. The market saw this as a vote of confidence from Elon Musk on its latest FSD updates. As a result, Tesla popped and gapped up when the market opened. At one point, it was up more than 6.5%. At the moment I saw Tesla jumped at the opening, I knew it was an overreaction by the market. Well, by now you should know that I love trading overreactions. And yup, I quickly took the opportunity to sell a covered call on Tesla, which is a slight bearish move. I basically think that such overreaction pop in the stock price is not sustainable, and 80 to 90% of gaps get filled, which means the chance of Tesla falling after the gap up was rather high. And it did. Tesla came back down a little and the gap is almost entirely filled. As a result, my trade is in the green right now. And apart from the unsustainable euphoria over a single piece of news, Tesla is reporting its Q1 delivery sometime this week. And with the latest data from China showing that Tesla could potentially miss its delivery numbers, I am not very hopeful of the stock price in the short term. Anyway, the strike price that I selected is $200, a level that Tesla could have difficulty breaking above in the near term. The contract will expire on 3rd May and the premium received for this trade is $600. Okay, so what does all this mean? Let's break them down. I'm personally looking at two possible scenarios on the expiration date. First, if Tesla stays below my strike price on 3rd May, I will get to keep the full premium of $600 without having to close my contract. This is rather straightforward. On the other hand, if Tesla shoots past my strike price, I will be obligated to sell 100 Tesla shares at $200 per share. For long-term followers of this channel, you would have known that I recently got assigned with 100 Tesla shares at $190 per share. Therefore, if my shares get caught away at $200 per share, the profit from the sale of Tesla shares would be $1,000. And don't forget about the premium of $600 that I received at the start. So if we add that in, the profit will be $1,600 in total. Not too shabby, right? Okay, just to clarify, there are other scenarios such as closing the position early or rolling the contract, but I will skip those for simplicity's sake. Anyway, getting assigned with 100 shares and allowing the shares get caught away, this is the complete options wheel strategy. Don't know what this is? Please check out the video linked at the top. Alright, next up, the second trade to update is this cash secured put on Google that expired last Thursday, 29 March. The strike price was $133 and the contract was sold on 16th February. The reason why I sold this put was again because of overreaction by the stock market. So what happened was that the market had overreacted to the news of a possible competition by OpenAI for Google's search engine. At the same time, OpenAI also released its latest AI product called Sora, which helps to create realistic videos from text. And so when this news came out, Google fell for 2 straight days, dropping more than 3% in the process. And once again, I took the opportunity to sell a cash secure put, which is a slightly bullish move. The reason was simple because at that point I was of the view that Google will bounce back. But I did caution viewers about the bearish signals showed on the chart and mentioned that Google could continue to fall. For more detailed explanation of this trade, please check out the video linked at the top. And well, Google did continue to fall after I made my trade and even went below my strike price of $133 at one point. But then it found some support at around 130 area as well as the 200 moving average. From there, Google bounced back up and look at where is Google now, 151. Since Google closed above my strike price on the expiration date, my contract expired worthless and I got to keep the full premium of $150 without having to take any further action. Finally, a very quick one, remember this trade that I shared in my previous video on how I have entered too early? I also mentioned that the MACD had a bullish cross, and the last 4 to 5 times when this happened, Tesla had a decent bounce. And tada! Tesla did bounce a little last week and my trade is in the green now. Okay, the message that I want to bring across is when it comes to trading options, it's normal to see your trade swinging from red to green and green to red. And it's really your own judgment call on whether you want to take profit by closing your contract early. I mean, like for this Tesla trade, I could have closed the contract anytime and locked in the profit because there is a risk that Tesla may plunge if the upcoming delivery numbers disappoint big time. Alright, some end thoughts to wrap up the first quarter of 2024. Well, most stocks climbed higher during the quarter, led by the big tech and AI companies. Other than the AI boom, another factor that was pushing the market was a resilient US economy. It's quite surprising to see how the economy remains so solid given the super high interest rate environment we are in. Anyway, with inflation continues to cool from its peak, the Federal Reserve has indicated that they are on track to cut interest rates several times later this year, with the first one expected to come in June. In case you're not aware, cutting interest rates is good news for the stock market because it eases the pressure on the economy and could potentially boost profits for companies. But that said, the progress on bringing down inflation has become a little bumpier recently, with some inflation reports coming in hotter than expected this year. In fact, one of the Fed officials, Christopher Waller, recently said there is no rush to cut the policy rate, and that it is prudent to hold this rate perhaps for longer than previously thought to help keep inflation on a sustainable trajectory towards 2%. So that's one potential headwind as we enter the second quarter of the year because the Fed may not cut the rate in June. Therefore, do pay special attention to the next few inflation reports as well as the upcoming FOMC meeting in May. Just to add on, apart from interest rates staying higher for longer, the current stock prices may have climbed faster than companies' actual growth and profits, leaving their valuation looking a little expensive. Therefore, as we enter the new earnings seasons this month, companies will need to deliver solid growth and guidance to justify their share prices and valuations. Okay, I hope that sums up the potential headwinds for the upcoming quarter. Alright, well, in the near term, it wouldn't surprise me if the market pulls back based on those headwinds, but I think the current rally still has room to run. Why so? Okay, here are some stats. According to Stratagas, the S&P 500 is currently up 27% from its October 2023 low. In the last 130 scenarios when the index rose 27% during a 5-month period, there was only one time which it had a negative return 12 months later. Alright, I know historical performance may not guarantee future market results, but would you want to go against the odds? Okay, history aside, as shared in my last video, what largely started as a mega cap and AI driven rally has showed signs of broadening as other sectors such as financial, energy and industrial are seeing solid gains as well. That's definitely a positive sign in a bull run. Meanwhile, for me, I am of the view that entering the market now is kind of chasing sentiment or chasing the highs. So if I were to pick up any shares during this period, I will not be too aggressive. All in all, I believe the AI story will not be over anytime soon. We are just at the beginning. But at the same time, I also want to respect Mr. Market and trust that there will be good opportunities and pullbacks for me to pick up shares more aggressively. Alright, how was your portfolio performance for the first quarter of the year? Anyone can let me know in the comments section below. Meantime, don't forget to hit the like and subscribe buttons before you exit this video. Thank you.